Have you ever wondered what happens when a mortgage goes unpaid, but instead of that becoming a problem, that being an opportunity? On this episode of the Passive Income Playbook on the Best Ever CRE Show, I'm joined by Chris Seveney, managing partner at Seveney Investments. Chris and his team have managed over 600 notes across 40 states, representing over 75 million in assets, making them one of the bigger players in the distressed debt space. While most debt funds lend on stabilized or fix and flip or new development deals, Seveney takes a contrarian approach. They acquire non-performing mortgage notes, work directly with borrowers to restructure the loans, and then convert what many see as junk paper into cash flowing, reperforming assets. Often they'll even resell these notes at a profit, generating equity-like returns from a debt strategy. In today's episode, we'll unpack how the non-performing note model actually works, why it can offer outsized returns compared to traditional fixed income funds, what LPs should know before investing in this niche. And, in general, if you're curious about how to generate passive income from distressed debt without actually having or owning the real estate, this episode is for you. And with that, let's dive in. Welcome, Chris.
Hey, Pascal. How are you today?
I'm doing really well. I'm excited to have you on the show. For all those who don't know, how would you? But Chris and I have known each other for a couple of years now. We're both in the men's mastermind group called GoBundance, and that's how we originally got to know each other. And we actually meet on a call, if not every Friday, every other Friday, to talk about real estate and fundraising and how the passive investments are performing. And so that's how I know Chris, and I'm excited to have him here on the show. Chris, I would love to have, before we get into maybe your specific strategy, can you maybe take us back into how you even got into this space of mortgage note investing?
Yeah, I always joke that I blame my wife. And reason I say that is I have been in real estate since I graduated college. I was a civil engineer. I worked for large commercial contractors. I managed a multifamily development segment of a company. But when I started growing my own portfolio and really started to try and kick it into high gear about 15 years ago, my wife and I were buying, back in the days, the BRRRR strategy, the buy, rent, rehab, renovate, and refinance in the DC area. And at the time, we also had 2 little kids. And after doing several of those and spending every weekend at the property managing it, because that was my background, my wife turned to me and said, okay, this is just too much with the little kids. So I then started doing additional research, and then I discovered mortgage notes. And most people have heard about private lending, debt funds, or lending debt. But what I didn't realize at that point in time was you could buy loans that are non-performing and buy them from banks or larger funds. So I started doing typical engineer, dive in and overanalyze everything. Took about 6 months, and then started buying a few notes about 8 years ago, and then 9 years ago. And then when I started doing that, all of a sudden I was like, wow, this is addictive. And it started at, 1 became 3, 3 became 4, 4 became 10, and just continue to scale to where I am today with now managing non-performing debt fund left my W-2 job and have 7 employees.
Yeah, it's awesome. I love it. So can you help us take a step maybe from a 30,000 foot view? And you kind of touched on it a little bit, but in your eyes, what are all the different ways that you can participate in debt investing? And maybe what are the pros and cons of this model in relation to the others?
So when people hear debt funds, there are different structures that exist within it, but they're all really doing the same thing. They're lending money. They're the bank. So you might hear, oh, I'm the bank, or be the bank. You are giving somebody money backed by real estate. And the ways people can do that typically you see is a private lender may give, Pascal money to go fix and flip a property. You hear the term hard money. That's another term that's tossed around. That's one option. Another is some larger debt funds they typically stay on the commercial side where they may provide some funding or financing for a multifamily project or new development or new construction or an existing building. And then there's the field we play in, which is the non-performing space, which is primarily on the residential side of both owner-occupied and non-owner-occupied. And that's where we're very unique from others, because when people hear owner-occupied, they typically run for the hills because of, the Consumer Finance Protection Bureau, the CFPB, Dodd-Frank, which are laws that are out there that were created after 2008 to really protect homeowners from unscrupulous lenders and originators back in the time. Because let's be honest, 15 plus years ago, there was a lot of fraud going on in the mortgage industry.
Yeah. And so this is one where, most people talk about either lending to investors.
Yep.
I think one of the big reasons is, one, you can have repeat borrowers, you don't have to go find a new customer every time. But two, then, you have consistency and understand of someone's ability to pay. And maybe that can make it a lot safer. There are a lot of people that also invest in doing what I would call it's okay. There's the stabilization and then there's the new development. And this is actually a strategy that's kind of past what I would consider maybe the riskier, development being the riskiest, value add being less risky, and then lending on a stabilized asset, in theory, is the least risky. And now you're buying underperforming loans. Where does that fit in on the risk bucket when you compare against those other two strategies?
Yeah, it actually can flow from all ends of the spectrum, because it really boils down to you're lending against that asset and the value of that asset. Now, if that borrower fails to perform or continues to fail to perform because they've already failed, you can still go get that asset. So we buy loans sometimes from 2014, 2015. And what has happened over the last 10 years on a price appreciation of a home? It's doubled or tripled. So a $200,000 home, 10 years ago is probably $400,000 today. If they owe $180,000, even if they're not paying, there's still your ability to either collect the payments from them or go get that property. So in that instance, we look at that as being on the lower risk scale. Where risk comes into play, of course, is verifying that property value, because we don't get to see the insides of these properties. So is it really 400? Is it completely gutted on the inside? And is it only worth 200? So it can really fluctuate depending on the scale, trying to understand and getting a really defined value of that property. But we look at the risk in our portfolio is how, like any investment, how we buy that asset off of the risk and try and do as much due diligence as possible to really make sure our numbers are pretty solid that we're going in with in regards to the values that we're estimating for value and other things.
Yeah. Okay. So now walk us through what are all the different types of products or scenarios that you might buy. So, I'm going to list off a couple to kind of give us some direction. So I know that, people falling behind on payments, you potentially buying homes that are just short of being completed. There are, I'll let you continue from there. I was just watching your, the 6 different case studies that you had of different types of deals that you've acquired.
Yeah. So typically, if it's a single family home, in almost any instance, we may consider acquiring the loan against that property. So like you mentioned early on, an investor loan. We have bought investor loans where it was a fix and flip that may have taken too long or went over budget. We've bought investor loans that were DSCR, debt service credit ratio, where it's a renter in there and maybe taxes and insurance have shot up and they're struggling with the payments. So we've bought those. We've bought a few construction loans, but those are far and few in between, and they're not strategic. They're part of a group of loans we buy, and there might be one in there. And, and then there's the other owner occupied property that the person's been in that property for, 1 year or 10 years that they, ran into some type of problem. Typically it's due to death, divorce, or job loss, or health is typically why people stop paying their mortgage. Most people don't wake up one morning and say, you know what? I'm going to roll out of bed. I'm not going to pay my mortgage this month and not go to, some people may make the option not to go to the gym, but most people don't mindset themselves that I'm not going to pay my mortgage intentionally.
Right. Walk us through the process of how you find out about these loans and then, what your due diligence process looks like in terms of deciding what's a deal and what's not.
Yeah. It's actually comical because you think, okay, this is part of a finance industry. So you think it'd be like really heavy tech savvy and everything. They send you what's called a tape. It's an Excel spreadsheet with a bunch of information across the top.
Who's they?
So that will be a bank, another institutional lender, a broker. And most banks actually don't sell loans to individuals because if you run a bank, you don't know who buys these on a secondary market. So they'll go to a merger and acquisition company, typically, who has a separate department called a whole loan trader that all they do is they sell loans for all the different banks all day long. And the bank doesn't pay the fee to them. The purchaser pays the fee of 0.5% or 1% on the purchase. So from a bank's perspective, it doesn't cost me anything to give you what we want to sell and you go sell it. Think of a regular real estate transaction. Most people don't sell a home on their own. They hire a brokerage to sell it for them. Banks do the same with their loans.
Got it. And so you start out with having a bunch of these relationships that you've made over time where these people at different banks and because you buy a lot from them, they have you on speed dial. Is that how I see it?
Essentially, for example, we had somebody reach out to us yesterday and like, hey, here's a small, it was only 2 assets. Were you interested? And he actually knew I wouldn't be, but he's like, I'll send it to you anyways. And we both joked because he called me and I'm like, oh yeah, you need to call this person. And he's like, yeah, I already called him as well. And he's going to take a look at it. Just so he wanted to try and get like 3 bids on it. But it's really a small niche space. And think about, most aspects of real estate. It is a really small space and everybody sees everybody and everybody knows everyone in the space. So it's also important to be of character and do what you say you're going to do.
Yes. Okay. So you have a few of these relationships. They send you an email or call you up and you get this in your inbox and then you have this buy box. This broker already knew that you weren't going to be interested. How do you look at your buy box? What does that process look like? I imagine maybe, first you look at some docs, then, if it still looks good, you might look at Google Maps a little bit more in depth. Like walk us through the details of what you can share at least.
Yeah. Absolutely. So you get a spreadsheet that typically has the property address, the amount that the original loan information, the current status of the loan, how far they're behind, the borrower's name, and an estimated value of the property. You get that information, and that's what you bid on. So they typically don't give you some of them will give you all the information, but most of them, and it's, indicative. You're just bidding based off of that initial information. So think about seeing a house on the MLS and just bidding on what you see and then getting it under agreement and going to inspect it after the fact. Now, typically in real estate transaction, no seller would allow that because they want to make sure the deal is going to close. In the note space, it's kind of common knowledge of that's how the process goes because nobody's going to spend tons of work on 500 assets before knowing whether or not they're going to get the opportunity to buy them. So you get that information. I'll get the spreadsheet. First thing that I typically do is, go in Data Tree, which is a website by First American, where I can confirm, okay, that's the borrower, gives me some high level information on the property. and base some values and use like a prop stream as well, and just confirm their values kind of match what we're seeing on that tape. We'll filter it typically by state as well and kick out the states that we don't like to invest in. Washington, Oregon, New York, Alaska, Hawaii, certain states.
Because
it's extremely challenging to deal in those states because of foreclosure laws. So each state has their own set of foreclosure laws. Some are called non-judicial, which is you don't have to go through the courts to foreclose. An attorney called a trustee will look at that mortgage and say, okay, we can follow what's in the mortgage and just go foreclose at the property or the courthouse steps. No judges or anything involved. A judicial state, so example, in a non-judicial state, you can foreclose in between 2 and 6 months, as an example. Very quick process. Judicial state is you have to go through the courts. So you actually have to file a lawsuit called a complaint and go through all the steps in that process. New York, you might as well start saving for your kids' college because it can take 2, 3, 5 years in New York. Hawaii, extremely challenging as well. Alaska, we just don't usually see anything, but is also challenging there. Other states that take longer periods of time, for example, most of the Northeast, Florida takes a long time to foreclose. So it really varies by state. So you really got to kind of know what you're dealing with in your mind of when you're doing this due diligence on these assets.
Is there any trend of like that being political, or is it just like, I mean, you mentioned, yeah.
You a little bit, interestingly enough, because you think red versus blue, and typically blue would take longer, and there are typically that's the case, but then all of a sudden, let me throw the big curveball at you. Foreclosing in California is very quick. Florida is going to take a lot longer. The difference is when you look at those states, if you have to now after you foreclose, if the person's still there, you still need to evict them. Now, evicting in California is a whole nother animal. Evicting in Florida is, I don't think you're off the phone with the sheriff's department and they're already putting that person out of the house. But to foreclose, so is it, where we see things starting to shift more is, the blue states that are judicial are getting much bluer, if that makes sense. It's much more challenging in longer periods of time to foreclose than the non-judicial, because there is no court system there. It's always going to be pretty quick.
And so you have all these, these things come in a loan tape. Do you get to pick and choose loans? Because you mentioned you're trying to toss out certain states, or do you, in some cases, do you have to buy them in bulk? Walk us.
Yeah, it's a mix. And really depends on, I think, that size of the tape. I got one this morning that is $77 million. And they came out and said, hey, the seller, of course, would look at a all or nothing bid of one person, but they realize they're probably going to have to take it in tranches. Same thing. We've had a tape recently. It was a $3 million tape. And in that instance, they're like, oh, this is definitely all or none because it was 7 assets and the seller didn't want to have to deal with 7 different buyers and 7 different contracts.
Okay. So you have this list, each scenario is different. You're weeding out what you like, what you don't, then what?
So then what we'll do is we run it through our, I'll call it calculator, which takes into account the risk involved, the property value, how long do we, every exit scenario we look at. If we have to foreclose, what does our numbers look like? If they start repaying on the loan, what do our numbers look like? If they file bankruptcy, kind of what does those numbers look like? And we've created essentially a spreadsheet where I can click a button and it actually ties everything together and calculates it. So, and then we evaluate each situation. And from there, we'll look at, okay, what's the worst case situation? And then provide a bid to the seller on the ones we want to bid based off of that. we submit them. And one of the nice things about submitting bids on notes is, unlike real estate where it's kind of first in, gets early bird gets a worm. Notes is, hey, bids are due Thursday at noontime. So if you send it on Wednesday, great. They're not looking at it until, Thursday at 12:01 when they get all the bids in. So it's not a huge rush, which was one of the nice things of why I got in this space was in my area, if I wanted to go look at a property, and my wife's working and I'm working a W-2, trying to schedule time to go look at something is impossible. I used to call myself when I got started the midnight to 2 investor. When my wife went to bed at night, I'd sit there and be bidding on notes during the evening when it's all nice and quiet, because you can do it from anywhere in the world at any point during the day as long as you have an internet connection.
Yeah, that's wild. Okay, so you mentioned that, so you're looking through these things. Some of these properties you're visiting, but maybe not all of them, maybe more in the beginning.
We don't spend a penny or go visit any of them before we bid. We are literally taking the seller's value at face value. Now, I'll go, of course, at Google Street View, and if I see the property has been knocked down or burned down, then it's like, okay, I'm not going to consider that. Or if the Google Street View is 3 months old and the property's boarded, we throw that out the window. But one of the things I think a lot of people get the misnomer of when they think of non-performing, they think of like vacant, abandoned homes. We've got a house right now, a loan we just bought right now, just outside of Orlando, Florida. I mean, it's a beautiful 5-bed, 3-bath house with a gorgeous pool and hot tub, and was renovated 4 years ago. So it's not just because the borrower's in distress doesn't mean the property is.
And so you go through your list, you pick a few out and you put in your bid and you say, yeah, I'd be interested in buying these. Do you submit an offer of like, I'm willing to purchase it for X, or is it the same way as buying a home where you're negotiating, where you put in an offer price?
So you take that spreadsheet that they gave you and you just add a column that says bid number, and you basically send it back to them. This is how old school it is. It's awesome because it's so simple. You send it back to them, and then they will typically come back to you and say, hey, we accept this offer, or they may counter offer as well. And there might be a little bit of back and forth. And, then they accept your offer. And once the offer is accepted, that's when you start the heavy due diligence. And that process typically takes 2, maybe 3 weeks, depending on how many assets are part of that you're buying at that one point in time.
Okay, so walk us through that due diligence process.
Yeah. So we focus on we call it the 3 Ps: the person, the property, and the predicament. So let's start with the person. We will first look at a background search on them. It costs $1.50. And this is insane. For $1.50, I could tell you the last time you got a speeding ticket. I could tell you how many speeding tickets you've gotten. I could tell you where you've got them. Any other, whether, crime somebody's committed or whatnot. One borrower one time had a 17-page rap sheet. It was, amazing to see how much trouble this person got into, because I didn't think somebody could get into that much trouble. And it's interesting because you also see what these people were sometimes convicted of. And they are so out there that you can't make this stuff up. Like stuff you see like in satire movies is like some of the crimes that we've seen. People
like,
doing things.
Give us one.
Doing things to animals, using an animal as a partner was one that just kind of, blew my mind. So one person was murder. I mean, there was one person on there who was a murderer. So it's like, okay, we'll pass on that one. We've had,
wow, that's crazy.
So yeah, I mean, there's some unfortunate stories as well where we were looking into it and did a search, and the woman's husband and son were shot sitting on the front porch on one of these properties. And it wasn't a bad neighborhood, so there's a lot of things that go into it. But when we look at that person, we run that search. But what we're looking for is criminal history, but also bankruptcy. If somebody's filed bankruptcy 7 times, they know how to scam the system. So we don't want those types of loans. We're looking for the types of people who, again, had an event that happened in their life that just gave them some type of chaos that they're trying to recover from, which leads to then that predicament of trying to figure out what that is. Now you're probably wondering, okay, Chris, how do you figure out that predicament? And all these loans are being held by a company called a servicing company. So for anybody on here who has a mortgage on their property, you never send your payment to the bank. You're sending it to the servicing company. And sometimes you get a letter in the mail that says, hey, now send your payments to this X, Y, or Z. That's because your loan was sold and now it's a new servicing company. So when that loan's sold, sometimes if you're non-performing, it could be me who the payments will be go to next. So as part of that, though, they have records of every single conversation. So think of it as a diary or a journal. Every conversation is documented so you can see all of those notes and go through all of those notes to see what happened and what is happening within the loan. So those two aspects of it. And then last, of course, and most important is also the property. So the way we check the property is we do send companies out there to take photos of the property from the street because you can't walk on private property. Well, then they'll have an agent or somebody provide some type of valuation. Typically it's called a BPO, a broker price opinion, which is a fancy way to say they take some photos, throw it in a computer, and basically, if you ever ask a real estate agent, hey, can you give me some comps on my property? They'll basically, when you go to sell your house, that's what they do. Same thing. So we'll get information from them in regards to where they think this property is worth. And the other major component we check is title. And we pull title on every property for multiple things. One is if we think we're buying a first lien note, are we actually buying a first lien note? Are there other mortgages on the property? Most people who are not paying their mortgage are also not paying taxes, not paying insurance, might not be paying their water bill or sewer bill. So what are additional costs that we might have to incur because, taxes usurp everything. It doesn't matter. If taxes are $1 that's owed, that still jumps in front of $1 billion mortgage in every situation. So definitely want to do that. We take all of that information and then, have an investment committee that reviews it, but we also take it and send it to an attorney. And we ask the attorney, review the title, review this information. Is there anything in here that could stop us from foreclosing or not allow us to? And some examples of things that we have seen in the past are a power of attorney was signed, but there was no power of attorney document attached to it. So it basically is invalid. The wrong legal description on a mortgage where, Pascal, you live at 123 Main Street. The mortgage doc says, see the exhibit. You have exhibits for 1015 South Street. It's like, it's not the same property. Those are problems. Also, when loans get sold, they have to issue what's called an assignment. So if I sell it to you, Pascal, there should be a document that says it goes from Chris to Pascal, recorded with the county. What happens sometimes is, let's say you sold it to John. Sometimes what gets screwed up is when I sold it to you, they forgot to record the document from me to you, but then when you sold it to John, John records it. So if you look at the chain, if you think of like blockchain of nothing should, everything is sequential, it goes from Chris to John, but it goes from Chris to John, but it never went from Chris to Pascal. That's a problem. So people always hear title insurance is like, oh, you always have to pay for title insurance and it's worthless. I can't tell you how many cases we've seen where we've had to go back to title insurance and file title claims. I'm involved in one right now on about a $700,000 issue where property was foreclosed on and the loan that we had bought was a refinance. So a borrower had, I'm just going to use a rough number, a $700,000 mortgage, but then they got a $300,000 mortgage in second position. When they refinanced that 700, we then, basically bought that loan from the refinance. The borrower went in default. Property got sold at auction for $700,000. So we got paid. That second lien holder got zero. They lost $300,000. They filed a lawsuit claiming that they're in first position, not my loan, for two reasons. One is because they were saying, well, our lien was recorded before ours, but on a refinance, it doesn't, you slide back. You're just replacing the position. It's like you're in line. You're just, having somebody, take a bathroom break and stand in line for you, but you're still first in line. And the other was they had a power of attorney that they're then claiming that they didn't authorize their power of attorney to sign the document that allowed us to slide in front of them, which that's not our problem. But this did take 3 years to get resolved. The title company with title insurance spent probably $100,000 defending this case. If there was no title insurance, I would have had to pay all that money to defend this. So wow. I kind of know I went off on a tangent, but I just wanted to kind of share the story of as part of this due diligence. And this was something that couldn't even be seen in due diligence. There's no way of seeing this, but there's so many other things that get picked up. Like we just saw one the other day where they had the wrong property addressed, or there's two people on the mortgage, but only one of them signed. So why didn't the second person sign? There's a lot of issues like that you need an attorney to tell you, okay, is this good or not? So that's really a big part of that due diligence, is flipping every page of the book to make sure we're checking every option. And I know some investors don't do that. They're just like, oh, yep, here's the money. Let's go buy the loan. And it blows my mind.
And then after that due diligence period, you basically say, yes, I'll take the loan, and the transaction completes, or no?
Yeah. It's 2-3 weeks, or we might adjust the price. The only reasons we typically adjust the price are the taxes were owed more than what we thought they would be. And that's a common, net taxes is a phrase where, hey, I bid 500 and if taxes are 10, then it's just 490. The only other reason is if the property condition or value is way off. And we see that a lot where some sellers will price a property as if it was a brand new construction in the neighborhood, where it's a 60-year-old house that, needs, some work to get it up to speed.
I wanna dive into returns here in a minute, and I also want to talk about maybe like the volume of loans you're talking about at any one time. But I wanted to take a moment and just pause here and speak directly to the LP, because I think this is what I want to highlight here is this recurring theme of Chris just walked us through his due diligence process, and if like what I'm taking away is how there's always a certain step. You'll hear about, he's first looking at a bunch of deals and figuring out, okay, are they in the right states or are they not? He has a defined buy box, and he's then, any opportunity that comes his way, he's immediately filtering using that. That's point one. Would you resonate with that, Chris?
Yes, 100%.
And then two, once things move on, only after he has looked at all these deals and used his top level filters is he then spending more of his time and resources of digging in. So, probably spending all that stuff costs money. Having someone, do that BPO, that broker priced opinion, to go take photos of the property from the street, or to get the attorney involved. Those are, I imagine, as Chris just even highlighted, there are some people that don't do that. And this is something that Chris does. And so when you think about your investing process, it should be a process. And you shouldn't be having deals come to you and you just try and evaluate, is this a good deal, without any frame of reference. You should have a system, a buy box, and a process to help you go through. And I think Chris did an amazing job kind of talking through how he does that. Any kind of comments there?
Yeah, 100%. And, when you think about, talking to an LP, and some of the things that I didn't even bring up is we do due diligence on who the seller is. Like who's that party that we're dealing with as well. That's also extremely important, because I think a lot of times LPs, and I'm an LP and I invest too, sometimes I'm the type of person where I like to look at the good in everybody. And sometimes unfortunately, and it's not that people aren't meant to, pose harm and so forth, but you always like to look at the positive in every situation and kind of form a basis or opinion on certain facts and so forth without using, again, I'm an engineer by trade, that engineering mind where I take the, heart component out of it and just use my brain on looking at the numbers, looking at the information, looking at what can happen in the situations, and really just having a system in place that is easy, simple, and repeatable, because that's important, as well as the harder you make things for yourself, the less likely you are going to do something. And as an LP, I've seen people who just overanalyze everything and then they never invest because they got the analysis paralysis as well. So there is that balance of you need to have systems to follow what you want to do as part of your due diligence with every, LP to GP, but you also have to understand that, you can't kill every single deal.
Yeah. And, just a quick plug here for the Best Ever community. If you are interested in understanding, putting together a strategy, having a system for investing as an LP, I definitely encourage you to check out the Cash Flow Academy and the webinar that we recently just put together that was marketed through Best Ever in putting together kind of a 3-step buy box system. But now that we've had the little plug, Chris, can you maybe walk us through a little bit of how, you have this process, this system for how you're going through and evaluating loans? I imagine that has evolved over time. How did it start? What were the early lessons you learned working in this space, and how has that due diligence process evolved? I imagine you're adding things as you have lessons.
Adding lots of things. And this is where a lot of people who are in real estate, experience matters, and you don't know what you don't know in most instances. And when we got started note investing, I'm the type of person where I'm always trying to learn, but I still didn't know what I didn't know. And it's just these unique situations of, things that occur. It's like that power of attorney thing I mentioned earlier. Like, I missed that and it cost us 6 months on a loan because we had to go chase down additional documentation. The biggest component for me was, and this was early on, somebody told me this and I agreed 100%, which is, don't ever fall in love with a property just because it looks pretty on the outside. It could still be a bad deal. So be careful with that, because let's say the borrower was a high profile attorney who can defend themselves at no cost. Is that somebody you really want to go up against? Most likely no. But the property value is the biggest lessons learned. And early on, when I got started, I was buying loans that were of lower value because of lower cost of entry. And some of them were, vacant, or even I thought they were vacant, but didn't do enough due diligence. And the one story I'll share with that was, and I still remember this, I can picture the house right now. It was in Cuyahoga County, and the borrower had the car parked in the driveway, had a light on in the front, so it appeared that they were occupied. But I missed in the servicing notes that they moved next door. They were living next door. And didn't make sense why, but I just kind of ignored it. And give some rough numbers. The property on paper was worth, and this is back in like 2017 timeframe things, property was worth about $100,000. They owed like $40,000 on the loan. We paid like $25,000 for the note. So we bought it at, a nice discount. The reason the borrower wasn't living in the property is because there's about 5 feet of water in the basement. That he just let it. He had cats running around the house. There was mold everywhere. So when we found this out, we basically tried to get access to go, by law, we can secure our investment. He was friends with the people at the water department, the people at the police department. And every time we go to do that, he'd send the police over. So they would basically threaten the people there to go like try and get rid of the mold and everything. So he made life hard for us. And this is, I remember this conversation vividly with the water department because we had to pump all the water out. And there was a manhole right in front of the house. Okay, that we're like, oh, we'll just run the hose and pump it there. First, we wanted to get a permit because we knew this guy knew everybody. So we get the permit. The permit office made us run a 200-foot hose down the street into a different manhole.
What?
We're out. Yeah. So we're out there pumping this. The day we're pumping, they come and shut us down. And they shut us down saying we're pumping to the wrong manhole, that we were supposed to be pumping to the one in front of the house. I just lost it on this guy because I was like, where on God's green earth would you think I would want to pay somebody to run a hose 200 feet down the street when we knew it was right there and you wouldn't let us? But this guy had me by the cojones. And the lessons I learned are, A, we typically stay away from vacant houses unless we can get access. But the other thing I learned from this is sometimes you got to lose the battle to win the war. And I was the type of person, always wanting to fight and try and win. And this one was a losing effort. And basically, I wasted way too much time and effort on this where I could have focused on other deals. But that's one aspect of the due diligence that kind of replicates many things of try and ask yourself the why. Why this guy moved next door? What was happening? Why is it vacant? And if we see something's vacant, other things we now check are we call the electric company, we call the water company. Is it turned on? Is it on? Because it might look sometimes like it's on, but we've seen people steal power from one house to plug in something in another. Oh, yeah, people crazy. Yeah. We've had people living in houses with no water and power. And unfortunately, they had little kids living in the house and they're, awful things that we've seen.
So I want to point something out here again, talking to the LP is the same thing that Chris has talked about here is when you get in the game, you need to have a basic system or checklist. And it's not going, you should set the expectation that every deal is not going to be a home run, that you're going to have 100% hit rate when you make investments as an LP. Because just as Chris here, as he got into the game in this specific niche, he learned lessons along the way that then informed and that he added to his due diligence checklist and iterated on and continued moving forward. And that's why, it's safer, it's probably more and more safer to work with someone like Chris, who's been in the game for a while.
Yeah. So one thing I want to add to that, Pascal, is, okay, Chris, you were learning that from experience, but if I don't have experience, how can I add or, get educated on the list? And the thing I would tell every LP is, ask people around you that are doing what it is you're doing, or reach out to somebody local, buy them lunch. I went and met with an attorney who was a creditor's rights attorney, bought them lunch, spent 2 hours one afternoon, brought my Remarkable with me, and basically took about 12 pages of notes. People, if you want to invest in a multifamily offering, go to, find somebody developing a new multifamily deal, say, hey, can I buy you lunch? And I just love to learn more about, what it is you do and the process and what made this deal happen. And I would say 9 out of 10 people would take you up on that offer at some point in time. Most people are willing to help you, but I think a lot of people sometimes are shy because they might feel like they don't have enough experience. It's okay. We all start at the same place. We all start at ground zero and take that time to continue to grow and learn.
I would love to kind of move on to this topic of returns. And after we hit returns, I would love to discuss risks associated with the model. But so, I think every time I do one of these operator style shows, we're talking to Chris. We want to understand if we, as an LP, were to invest in this strategy, maybe specifically with Seveney, how do you structure your fund and why? I guess, how do you structure your fund? I've got some things I want to dig into there.
Yeah, no, absolutely. And I know you've done deep dives on our funds too. So we have two funds. We have a Regulation A, which open to accredited and non-accredited, and then a Reg D 506C, which is more traditional.
So if you're an unaccredited investor out there, which is usually, this is a fund that you can look at.
Yep. So our minimum investment right now is $5,000. Our returns are between 8 and 11%. And some people, interestingly enough, look at that and say, that's great. Other people look at that and say, that doesn't get me out of bed. And it really determines, are you in an equity play or an income play? Most debt funds are income plays, meaning that it's a cash flow play. There's not huge upside like building a new construction project and getting that sale in 5 years. They're typically a bunch of pooled loans that just provide that consistent cash flow. The way we have structured our fund, slightly different than some of the other ones that you see. First, we do have that Regulation A plus offering that is open to non-accredited. Along with that, what that means for us and for an LP is, we have to submit to the Securities Exchange Commission. We submit to them where they review the offering. They never approve anything. They review it to make sure it meets their standards. And then we would get what's called qualified. And then that allows us to go sell these on the open market and actually be able to advertise to non-accredited investors. That also requires us to do audited financial statements as well. So we have to be extremely transparent. The other avenues that we structured within our fund is, we currently don't have any debt. And debt is, in the phrase, an enhancer. It can enhance returns. It can enhance risk. It can enhance losses. We don't have any debt on our books. So when you look at the capital stack, our investors are at the bottom or the base of the stack, which is, first in line, essentially. The other aspect that we structured it was, I own 100% of the common shares. I'm a salaried employee. So we didn't fee it to acquisition, disposition, management, and all these other types of fees. I collect a paycheck every 2 weeks, and I don't get any of the profits from the company until all the investors get their returns that were to them. So, tried to keep things as a, win-win for all parties involved. And I looked at many different factors of, I come from corporate W-2. Also, I've invested in LP. I've ran multiple funds earlier, and those funds were smaller, but I was using those as, I'll use the term testing funds, where I go raise several $1 million, see which strategies work in regards to returns. Is there upside versus pref? Is there 2 years versus 4 years versus 6 years? Kind of use that to fine tune my model before we launch, the fund we are in right now 3 years ago, and, structured it from that standpoint.
So your firm does something that I've seen is not it's not common, but I find it uncommon, which is this concept of buying or receiving additional shares.
Yes.
And could you kind of explain that topic, for anyone that has no idea what we're talking about, and why you chose that?
So, great question. So in the Regulation A offering, the investors are shareholders. So think about buying Apple stock. You're buying shares of our company, which is incorporated under CWS Investments. You become a shareholder at $10 per share. And we were trying to provide some type of incentive for investors who invest more than the minimum. And you see that in a lot of funds where they can provide additional returns if you invest more, or provide some type of upside for those who put more money into the deal.
Because it is easier to manage one investor who puts in a larger check than many who put in smaller.
Yeah, and we have 800 investors right now. So, but when we were going back and forth with the SEC on what it is we can and can't do, we were looking at different structures or ways to structure this And the simplest way was to provide what's called bonus shares. So if somebody invested $25,000, that's 2,500 shares, we would give you 100 extra shares. So you would have 2,600 shares that had that preferred return of 8%. So you get 8% pref on 2,600 shares. And then when you cashed out, when the time you wanted to cash out, we have a 4-year lockup. You can stay in longer than that or cash out half, whatever it is. Then you would get, those extra bonus shares, you could cash those in as well. So you cash in 2,600 shares. So you get proverbially $26,000 at the end versus the $25,000 investment.
So an incentive play. So talk to us a little bit about the illiquidity. So there's a lockup of 4, and I think I saw that you maybe get a higher return whether you stay in for 4 or 5 or maybe even 6 years. You can correct me here in a minute, but I'm thinking through why are you holding it for 4 or 5 years instead of maybe doing like a 1-year lockup? Or I imagine some of these loans, when you take them on, you don't know how long you're going to hold them for. It sounds like they're for shorter periods of time, but they can last 3 or 4 years. And you are giving monthly cash flow from these. So walk us through maybe that decision. That's obviously a fun decision that you've made.
Yeah, no, 100% a fun decision. The lockup average loan is, we'll say 12 to 24 months. And we came up with the 4-year. I had done prior funds that were 2 years, 3 years, and 4 years. And the 4-year gave the maximum flexibility because in 2 years or 3 years, what would happen, especially in the 2 years, you might get to the end and have some lagging assets. And, those, if they drag on, can just drag on. So we wanted to give ourselves, I'll call it 2 full cycles of if each loan took 2 years, 2 full cycles of loans. So that was one reason of that determination. And it's very similar to, people who are doing, I'll call it any type of fix and flip or new construction product. You need time to ramp up because, it takes time to get, rolling and going, where some other debt funds, yes, they're 12 months, they're originating their paper and they've got, the 100% of that cash flow and everything coming in immediately. The other component to this was we also play in the broker dealer space. And, broker dealers get paid a commission that gets paid upfront when the person invests. And they, if you're paying a commission of, let's just say 5 or 6%, if that's only over a 12 or 24 month period, that's, 2 to 3% per year. That can have a pretty big snip off of some of those numbers, where if you spread that out over 4 years and it's an extra percent per year, in that bucket, it makes the numbers work. Debt funds that also sometimes use like broker dealers. I was talking one the other day, they were, and we were just sharing things, and they're doing a 2-year offering, and they basically were like, yeah, we can't do the broker dealer space because the numbers don't make sense because of, the commissions that get paid through that. Typically you see those offerings, some of the DST stuff that goes through those, those are 4 or 5+ years because of, you can't, in a debt fund, when you look at the returns and you back everything out and so forth, they're the ones who would be making the most money out of everybody in the deal. So that was another reason. And we have had people not invest because the lockup is 4 years. And then we have other people who are like, this is great because I don't have to think about anything for the next 4 years and, spin my brains on a decision of where I want to move my money.
Right before we get into risks, I want to talk about the profitability and the different way these things are made. So you're buying an underperforming loan. In most cases, you are working out an agreement with the borrower, getting them paying again, and then reselling the loan. There are cases where you take over the property and you need to finish it up and sell it, and you have the unique ability where, I know that you don't like to do that regularly, but you have the ability to take on and close out a project. You know, I've heard, I think, maybe scenarios where you have a loan for $200K, but the building is worth $1 million, and you're making, walk us through how small some of the profit can be, and maybe how large, and then we can talk about the risks. I think that'll be a good lead in.
Yeah. So great question. And there's typically, I'll start with how you make money, because that's one of the questions everyone asks as well. If they're not paying, how do you make money? And I'll call it, the road splits in two directions. If you take the road to the left, that is the borrower wants to play ball with you. And if the borrower wants to play ball with you, then that means they've got some money and the ability to start making some type of payment plan. So I'm going to use some really simple numbers for people. Let's say they owe $100,000 on their house. Let's say the house is worth $200,000. We buy that note for $70,000. So we bought it at a 30% discount. We finally connect with that borrower and say, give me $5,000 down. And if you can continue to make for the next 6 months your $1,000 a month payment, we'll take all the past due fees and everything, we'll put it into a new loan balance and recast that loan, basically like re-amortize it, and the loan maturity date might extend by 2 years or whatever the case may be. So when you look at the numbers like that, you get $5,000, from them to start, and then they make 6 months of payments for $1,000. So now you got $11,000. You adjust the loan. The reality is most people know, the majority of money for most of the loan goes towards interest versus principal. So that $100,000 balance didn't come down by $11,000, even though that's what they paid, may have come down by $5,000. Now that borrower is called reperforming because they're back paying again and got the loan current and continuing to make payments, we turn around and we'll sell that loan that's now at $95,000 balance at 80 cents on the dollar, which would be $76,000. So if we started at 70, got 11 at 59, sold it for 76, now we just made $17,000 on a $70,000 investment over the course of a year. Maybe it takes 8 months. On a non-performing loan, you're going to want to target some type of return starting at around, on a loan by loan basis, of 20%, plus, because of, we'll talk about risk in a second. So the other options that can happen in that situation is the borrower might refinance because you got them current on a loan, so you're helping them get their credit. So maybe they refinance. Maybe they sell the property. Some people sell the property. You can still get a full payoff at that point in time as well. If they don't play ball, then you do have to go that foreclosure route where you can either offer them cash for keys to give you the property, or you go through the foreclosure process. At foreclosure, we had one recently where we were owed $130,000 on the loan. The property sold to a third party at auction for $150,000. So we get our $130,000. Somebody else buys it, so we don't have to take that property back. Some instances, as you mentioned, yes, we do take the property back, and we've got the ability to, update it or do other types of components, as you mentioned. Not something that we want to do on a consistent basis. Do I sometimes get that little itch from 25 years of doing that to do it once in a while? Of course I do. But you also quickly remember all the headaches of why I got out of that business as well.
Yeah. And then maybe like a best case scenario, what's been maybe your best deal?
The best deals are the ones when some of the lenders don't know what they have. Perfect example, I'll give two. One of them was recent where the loan was non-performing. The unpaid balance was on the loan, we're going to say $500,000, but all the fees and stuff because of default interest and everything was about $700,000. Okay. We paid $500,000 for it, for a $700,000 loan. The property was on the market, sale pending. So we bought the loan. 4 days after we bought the loan, they sold the property for $1.1 million. We got $700,000. So
Wow.
we literally made $200,000 in a week. So
Wow.
that happens more often than you would think, believe it or not, because some of the lenders don't have a full asset management team. And the reason we have one is because we deal with defaulted loans. Your institutional guys, they don't have asset management to deal with this. They let their servicer, they hire a third party attorney or somebody to work this. And the servicers aren't watching whether a house is on the market for sale or not for sale or things along those lines. Another deal I'll share with you was a loan that they thought was a second position loan. And they thought it had a big first in front of it. So they thought the second was underwater. And it was a $150,000 loan. And we paid $8,000 for the loan because, again, they thought 90% was underwater. There was no first mortgage on the property. So we bought $8,000 for $150,000. We started borrower's default. We started foreclosure on the borrower. The prior lender did not do anything. When we started it, they cut us a check for $150,000. So, there's instances like that. From a loss perspective, just because you're going to ask, well, what about the losses? And we'll talk risk. I'd say the biggest loss we've ever had on an asset, and I'll share this story, was we bought a loan. It was in Alabama and paid $120,000 for the loan. The property value from our agent and everyone was around $200,000. And we ended up selling the property for like $80,000 or $90,000. So you can say we weren't happy with the agent that told us it was worth about $200,000. And we listed it for sale at $180,000. And then they're like, no showings after a month, no showings. And some of the comps we saw in the area were, $150,000 to $200,000. But, the inside of this property just needed probably $50,000 to $60,000 worth of work. And we, at that point in time, did not want to, it wasn't worth the effort and time to, instead of lose, call it $30,000, to lose 20. I'm not going to spend people's resources, because we look at, okay, maybe we could recapture 10,000 of it. We'd be much better off focusing on new loans that can make us more than that type of loss.
Yeah. So I imagine all these risks are risks that you slowly move away because you have improved your due diligence process and have more experience.
Yeah.
And I imagine maybe the risks are different, probably still in the industry wide, there are risks, and then maybe risks that are smaller risks because of the due diligence process. But tell us more. So one is comps, like one of the risks is just like the inside of the place, because you can't go in there. You have no idea. And so that is a risk. What are the other types of risks that
So I'll look at, there's controllable risk and uncontrollable risk. And the way I factor what's controllable, some of that property values, I view that as controllable. I probably could have done a better job and did more on that. Other types of risk are not only the value, but where's the property located? If it's in a very rural area, it could still be a nice property, but it could take you a year to sell it, especially if, we've seen property in the past. There was this one property that was owned by a former football player in Pennsylvania, Western Pennsylvania. And guess who he played for? And this house was like a 13,000 square foot house, literally in a small town that I don't think any other house was above 2,000 square feet. So we did not buy that loan, but that's another type of risk that's kind of like common sense in regards to understanding the property. The uncontrolled type of risk is a borrower suing you. Borrower can sue for anything. A borrower can contest a lawsuit. A borrower can hide, so you can't serve them with a lawsuit. so that can stretch out your time. So, and I've had every single one of those happen to me. Some other controlled risk that also, we are a very vendor driven business. Attorneys, servicers that we use, time is money and such an important factor. If you're working with an attorney or a servicer who moves at a snail's pace or kind of comes and goes, and when I got started in this business, I was like, oh, wow, an attorney, like you put them on a huge pedestal because of how smart they are and everything else. Doctors, same thing. We all know somebody who's a doctor, an attorney, a dentist, an engineer, who you wonder how they can get out of bed and tie their own shoes in the morning. And the reality is some people can be the smartest on the planet, book smart, but no personality or no street smarts. And that is such an important component, where we had a case recently where, we were already, I'll use a phrase, but pregnant with this attorney that they've done, we've been with them for about 6 months and already gone down the road with them. So we're kind of like, okay, now we're married to them and just got to, live with them. And this attorney was just so painful. And we kind of were like, it's one of those things like anything. We should have broke up with him. We didn't. Finally, he got fired. And then they have a new attorney on board that we're working with. And the new attorney within the firm is asking us, why do you do this? Why do you do that? Like, what? None of this makes sense. And I'm like, thank you, because we were asking some of these questions, but he was giving us a response that sounded good enough that, because we're not attorneys. So he could talk the talk. And, we were kind of just going with it, and now got everything turned around. And again, looking back at a controlled risk, vetting, due diligence, on your vendor is extremely important.
Man, all the things you learn as you build and invest and build a portfolio. Chris, this was incredible. I thoroughly enjoyed this. I think our listeners will also get a very great takeaway about note investing. Where can investors learn more, find more about you, connect with you online?
Yep. So they can go to our website, 7einvestments.com. That's the number 7, the letter E, investments.com. You can find me on LinkedIn. There's only one other Chris Seveney that I know on the planet. So just pick the better looking one and you will get me. So yeah, that's the 2 places most people reach out and communicate with me, is either through our website or, of course, on LinkedIn.
Amazing. And as a reminder, if you are looking for LP deal flow, like some of the opportunities that Chris has, his Reg A deal and his 506C deal are both in our database. You can find that at passiveinvestingstarterkit.com. It's one of the best ways to see over 700 different deals that I update every week, so you can be a better investor and have better selection. And with that, this is the Passive Income Playbook, part of the Best Ever CRE Show. We drop new episodes every Thursday, so be sure to tune in each week. I'm trying very hard to bring you stuff that I think is helpful. As always, if reach out to us on LinkedIn, just say hi, let us know that you loved a certain episode. That really helps. And, thanks for tuning in. We'll see you next week for another episode of the Passive Income Playbook.